Thank you, Jan. Thank you, Jan. Hi, everybody. It's great to meet you. Give me a second. I will share my slides. Okay, so we're going to talk today about why your 990 and audit matter for funders. But before we dive in, I want to just give a little bit of an overview with YPTC, or your part-time controller. We're a professional services firm that specializes in with nonprofit financial management. We've been in the industry for over 30 years of working with nonprofits. Our services include accounting, reporting, data visualization, and financial best practices. And while we don't perform audits or prepare the 990s, we do work closely with our clients to help them get ready for both. And today, our team of more than 800 professionals supporting nonprofits across the country, about 2,300, we tailor our approach for each organization, whether it's on-site or remote, to help support each client's needs. I'm Nicole Frisina. I am honored to be here today. I've been in the accounting industry for over 20 years. I started out my career as an auditor, then worked in the private sector for several years before joining YPTC a little over 10 years ago. And during my career here, I have worked with nonprofits in all different industries and sizes, and I have seen firsthand how the topic we will talk about today creates impact for each organization. So just kind of giving you a little bit of an overview. So your audit and your 990 are more than just simply compliance checkboxes. They're often the funder's first window into your organization. In today's session, we'll look at how funders are using these documents, which sections they review most closely, and ways to present the information in a way that builds trust and address questions proactively. We're going to break this down into these 4 sections. We're going to first start with the introduction and then do a brief overview of why the audit and 990 matter. Then we'll talk about the audit itself and some key areas that funders will review. We'll then talk about the 990 and some key areas there that the funder will review. And then we'll end with some best practices, things to address on that end. So kind of talking about why does this matter? So for funders, your audit and your Form 990, they're not those background documents, but they are that window into your organizations. Decisions will be influenced by these documents well before you ever get a meeting with a funder. The good news is funders are not expecting perfect numbers. What they're looking for is transparency, clear explanations that they can trust, and that's exactly what we're going to focus on today. So let's talk about why these reports matter. First off, financial integrity. This helps assures funders that your financial information is accurate, reduces the risk of fraud, and demonstrates strong financial oversight. Then compliance. It's just allowing them to confirm that you're meeting IRS and other regulatory requirements, including maintaining your tax-exempt status. Program impact. It allows the Form 990 highlights your program's accomplishments, helping funders understand how their contributions are supporting mission-driven work. And benchmarking. Funders will use these documents to compare applicants, looking at things like overhead ratios, program spending, and revenue mix to assess relative risk and sustainability. And finally, transparency. And this is a key point. Both documents are public, especially the Form 990, and making them easy to access, like adding them on your website, helps strengthen confidence and trust. And funders will want to know that you're accountable for the resources that are being provided, and that these reports help them make them clear. And so very often, your audit and Form 990 are a funder's first glance into the organization, sometimes even before a conversation even happens. So starting with the financial statement audit, the audit is confirming that your numbers are reliable and reviewed by an independent CPA firm. For funders, that signals strong financial oversight and discipline. And then the timeliness of the audit does matter too. As a general practice, we recommend aiming to complete the audit within 90 days of year end. And when an audit is recent, it reassures funders that the organization is well managed and staying on top of its financial responsibilities. Delays, on the other hand, could raise questions about governance and risk. And then funders are typically looking for a clean or unmodified audit opinion with no unresolved issues and consistency from year to year. And as an important reminder, the purpose of an audit is not for auditors to review every transaction, and auditors are not responsible for detecting fraud. An audit provides reasonable assurance, not a guarantee, that's something that's helpful for nonprofit leaders and funders to keep in mind. Now, turning over to the Form 990, the Form 990 provides a public snapshot of your finances, governance, and mission activities. Funders are using this as transparency tool and often compare it closely to the audited financials. And then filing on time here demonstrates reliability and compliance. And late filings often will prompt follow-up questions from funders. But funders also want to see alignment with the audit, a clear description of mission and program spending, and governance and compensation practices that appear reasonable. And one final point to mention here, that failure to file a required Form 990 for 3 consecutive years will automatically result in the loss of tax-exempt status. That's not a discretionary fact, it's automatic. And it's a compliance risk that funders are watching for. So that kicks us into our first poll question here. So if Elijah, you could pull this up. But our first poll question is, funders will use the audit and Form 990 primarily as tools to assess which of the following items. Is it A, compliance with IRS filing requirements? B, financial accuracy and internal controls? C, program effectiveness and governance strength? Or D, organizational stability and transparency? Now, as you're voting, think about which option is the most overarching factor, the one that the others may roll up to, or will roll up to, actually. Give everyone a chance to do that. And are we able to share the results?
You want me to end it now?
Yeah, that'd be great. Thank you. Perfect. So yes, exactly. D is the best answer here. The other items are absolute pieces of how the fund are important, and these are how funders are getting comfortable with it through the organizational stability and their transparency. So on that note, thank you, Elijah. Let's turn over to the audit. Oh, forgot to click on that. Okay, so for the audit, when the funders are opening the audit, they're typically looking at 4 items: the opinion, liquidity, sustainability, and red flags. And everything else around it will help support those questions. Now, funders are not going to read every page of the audit. They are going to focus on those key areas to help assess an organization's financial health, compliance, and their risk. So first, under the auditor opinion, this is the first place that the funders will look at. Is it unmodified or a clean opinion? That signals reliability. They'll also look to see if there are any findings or going concern issues. If they do exist, then they will want to understand what they were and how they were addressed. And then finally, they're going to look at whether the audit was completed on time, which of course will also reflect strong financial management. Next, we're going to look at the statement of financial position. On this, the funders are focusing on liquidity and how much cash, how much unrestricted cash is available. They'll look at debt levels and the mix of restricted versus unrestricted net assets. So too much restricted net assets might raise questions about flexibility or make funders question how donor requests are being managed. And while too much unrestricted net assets might lead funders to question overall funding need. And then on the statement of activities, or also the functional expenses, funders are looking at revenue sources and whether they are diversified. They'll pay close attention to expense allocations, especially program versus administrative costs. And they'll watch trends over time. Are there consistent surpluses or ongoing deficits? Oops, I'm sorry. And then finally, they're going to look at the notes section. The funders are relying on the notes section to help provide context, including accounting policies, commitments and contingencies, related party transactions, and events that have occurred after the year end. We'll take a deeper dive into these areas, starting with the audit opinion. So here's a sample of an unmodified or clean audit opinion. Here in this section, it's saying that it's communicating that financial statements are presented fairly in all material respects. It's also indicating, that what year it's doing it for, and it's in accordance with GAAP, right? Generally accepted accounting principles. Then further down the line, they're going to look at the completion of the audit. When was this completed? This appears at the end of the audit opinion letter, and this will date, how this date helps them assess how current the information is. It represents when the auditors completed the audit work. This may not necessarily be the date that they issued the report. And if something notable did occur in the interim period between completion of work and the issue date, then that subsequent event would be disclosed in the notes section of the audit. And it's a best practice aiming to complete the audit within about 90 days of year end is a best practice. So next, we're going to look at the statement of financial position. This is an important report for funders because they're using it to assess the nonprofit's overall financial health. First, funders will compare current assets to current liabilities. On the statement of financial position, items are listed by liquidity, assets by how quickly they can be converted to cash, and then liabilities by when they're due. So here in this section, current assets are expected to be used or converted to cash within 1 year, while current liabilities are obligations that are due within 1 year. So when assessing liquidity, funders will ask, are the current assets greater than short-term liabilities? If yes, as in this example, it's nearly double, more than double. Current assets are more than double than current liabilities. It's telling the funder that the organization can cover its immediate obligations. Next, the funder will review the mix and the composition of assets and liabilities and net assets. They'll look at current versus non-current assets, and they'll pay close attention to debt levels, both short-term and long-term. So for example, in a large investment in property and equipment can limit flexibility since these assets are not easily converted to cash. And then third, they're going to look at debt levels and liquidity. As we see here, owning buildings can support mission delivery, like a theater for for a nonprofit arts organization, but it also brings ongoing costs and debt obligations. So in this instance, if you're showing on your statement of financial position that you're setting aside funds for upkeep, like a building reserve, it'll help signal proactive financial management. And then finally, funders are looking at how restricted funds are managed. Too high of a percentage of restricted net assets can limit flexibility. And more concerning, if unrestricted net assets are negative, it may signal the organization is relying on restricted funds to cover operating costs. This is a red flag for funders. Managing donor-restricted funds responsibly is critical. So, to recap, the 4 things funders are using to assess financial health on the statement of financial position are comparing current assets to current liabilities, evaluating the entity's composition of assets and liabilities and net assets, reviewing debt levels and liquidity, and assessing how restricted funds are managed. Now let's take a look at the statement of activities. On here, this will help the items here that a funder will use to help assess financial health. They're first going to look at net assets across all columns. A positive change across all columns indicates that the organization brought in more resources than it spent. A negative change, especially in without donor restrictions, could raise sustainability concerns since those are the funds that are used to support ongoing operations. Funders will also compare these results across multiple years to identify any trends. Next, funders are going to review revenue diversity. Heavy reliance on a single funding source, such as one grant or one major donor, creates risk. A healthy mix of earned income, like program fees, and contributed income, like donations and grants, generally provides more stability and flexibility. In this example here, this organization, their program fee income represents about 74% of total revenue. That can be a strength, but also could be a risk, because funders will consider how sensitive that revenue is to changes in demand or participation. And then funders will also examine donor risks, donor restrictions. Even though it's not the case here, large balances with donor restrictions can mean resources are tied up and possibly not available for current operations. And as mentioned earlier, it's important to periodically confirm that releases from restrictions are in alignment with donor stipulations. So to recap, the three things that funders are assessing on the statement of activities are a positive change in net assets, revenue diversity, and a manageable balance of donor restricted net assets. We'll talk about expenses in the next slide here when we look at the statement of functional expense. So just give a quick refresher on the functional categories. Program costs, these are the ones that are directly tied to delivering your mission. Things like program staff salaries, supplies used in programming, and food or materials for beneficiaries. Then management and general expenses, those are supporting oversight and governance costs that can't be directly linked to programs or fundraising. These are typically including executive leadership, administrative staff, office costs, interest, things along that line. Next is fundraising expenses. With fundraising expenses, these relate to activities aimed at general contributions, such as fundraising events like a gala, campaigns, materials, and staff or consultants who support those efforts. Now, some organizations, if like you're a membership organization, you may also have a column for membership development. This is relating to soliciting members or collecting dues, but that's not shown here, but you could definitely have that as a category. Now, in addition to the statement of functional expense being required by accounting standards and the IRS, the percentages are closely scrutinized by funders and charity watchdogs. These groups are often are using as one indicator of efficiency, though of course it's always important that the context does matter. And then funders will also look at whether an organization's functional expense mix is reasonable compared to a similar organization, not just whether one category seems high or low. Because many costs support more than one function, nonprofits must document how shared costs are allocated. Common methods include payroll percentages or square footage for shared spaces. And while accountants will handle the calculations, the allocation policies themselves are part of management and board decisions. And funders will want to see, sorry about that. Funders will want to see whether these policies are well documented and if they're applied consistently. All of this together will help the funders assess whether the resources are being managed thoughtfully and transparently, not just efficiently. Now that we've talked through what funders are looking for in your financial statements, these red flags, we have them listed here. Now, funders aren't looking for problems. They're looking for reassurances that leadership and the board understands the issues and have plans to address them. Most audits include at least one area funders will pause on, not because it's wrong, but simply because it's prompting questions. So red flags could be signs of ineffective governance or declining financial independence, some of which are shown here. So the key takeaway here is, if any of these issues exist, don't ignore them, but address them proactively. Red flags on their own aren't necessarily deal breakers. What concerns funders more or most is when issues persist year over year without a clear explanation or corrective action. For example, on this list, having recurring operating deficits, being able to show proactively how you are addressing it. Is the operating deficit due to reduced income because of low demand or government funding cuts? Being able to explain how you are proactively handling that, like looking to diversify the revenue in other sources, maybe like foundations or corporations, or potential expense cuts. Your audit footnotes and your Form 990, which we're going to turn to in a minute, those are powerful tools to help provide that context and explaining what's driving these issues and communicating what management and the board are doing about them. And this slide here is a guide to help interpret the financial signals that funders use to assess confidence and funding decisions. Now, while not every single one of these points are directly included in your organization's audit, they are all tied to directly sound financial management. So what builds confidence? These items here. They're reflecting a nonprofit with strong financial health, demonstrating stability, sustainability, and the ability to adapt to challenges without financial strain. Now, signals that funders will watch closely are here. These issues may not indicate immediate trouble, but emerging financial pressures or uncertainty can make funders pause. Regarding budget variances, while these are not included in the audited GAAP financial statements, funders may ask about variances after reviewing audited results that differ from expectations or forecasts or prior communications. Similarly, payment delays aren't disclosed directly in audited financials either. That said, funders may infer timing stress from things like rising payables, or maybe a weak operating cash flow, or liquidity disclosures. These are indicators that may lead funders to just question whether the organization can pay their obligations on a timely basis. And some unhealthy signals, these can indicate that the organization may struggle to meet their obligations, maintain operations, or sustain its mission without corrective action. Regarding donor restricted funds, these generally can't be borrowed, even temporarily, and funders will view suspected use of restricted cash to cover operating shortfalls as a serious red flag. The key point, though, is that funders are not expecting perfection. They're expecting awareness, transparency, and a plan. So now that we've kind of looked at how these signals are on the audit, let's take a look at some of these same themes and how they show up on the Form 990. But before we get there, we do have another poll question. So when this issue appears repeatedly, which indicator is most likely to prompt funders to ask follow-up questions first? So Elijah, you could pull up the poll. Now, the options are, is it late audits or recurring audit delays? Low liquidity or limited operating reserves? Growing debt or inability to meet obligations? Or heavy reliance on a single funding source? Now, as you're answering this question, think about which of these would raise questions year after year, not just once. Elijah, are we able to close the poll? We had a very big mix here. So now all of these absolutely matter. I completely agree that growing debt or inability to meet obligations is definitely a red flag, but having recurring late audits or audit delays is a first thing that'll raise governance and overnight concerns for funders because timeliness does speak volumes for funders. And from there, they'll start asking the questions about liquidity and debt and the revenue concentration. Thank you. So now let's go into the Form 990. So let's we're going to review some key sections that the funders will typically review when evaluating an organization. If the audit is answering, are the numbers reliable? The Form 990 is answering, does this organization govern and communicate responsibly? So each section in the core Form 990 listed here gives funders insight into governance, financial health, and alignment with mission. Funders also use the Form 990 to calculate and compare ratios like program versus administrative expenses, and to check for consistency with what they're seeing in the audited financial statements. A high-level overview of some of the sections we'll focus on today. We'll first talk about the summary. Funders here are looking for consistency between your mission statement and the proposal that you're providing to them. They want to confirm that your activities are aligning with your stated purpose. Then in the program service accomplishment section, this is where the organization should clearly communicate the impact of its major programs. Funders are looking for measurable outcomes and are paying attention to any significant changes in service. For governance, funders are taking note of governance practices in place and often are paying close attention to whether the board reviewed the Form 990 before it was filed. Compensation, this is presented in this section here, and it's assessing whether compensation appears reasonable. And then revenues and expenses, in two different sections, funders are evaluating how diversified the revenue streams are and whether the expense allocations appear reasonable and consistent with the organization's mission. Now, the public support test for public charities, funders want to see that the organization meets the IRS public support test and maintains a broad base of funding, not relying too heavily on one source. And even without seeing individual donor names, funders can often tell when revenue is concentrated by looking at that public support trend calculation. And then in the supplemental information or Schedule O, this section provides important context and especially around explaining governance details or any unusual or complex financial items. So we're going to walk through each of these sections with some screenshots so you can see exactly what the funders are seeing and how it can be interpreted. Now, in part one of the Form 990 is the summary snapshot. It's often the very first thing that funders are reviewing. It gives them a quick high-level picture of your organization's mission, financial health, and compliance. And a few key things that funders will focus on is the mission statement. They want to see, does this align, with, does your mission align with the grant narrative that was provided and reflect your current priorities? If it's outdated, it could be a red flag, even if the rest of the Form 990 is strong. So whenever I go through this with my clients to go through the 990 and prepare for it, I always ask them, review the summary first, review your mission statement here. Does this make sense? Does this align with what current priorities are? And then also it provides clarity for the funders. Keeping the mission description short and clear doesn't make funders have to flip through pages and understand what your organization is doing. So simple statement here is one example provided. So here it's saying that this organization, their mission is to advance economic opportunity for underserved young adults through workforce development, career coaching, and employee partnerships. It's very simple, to the point, but you're getting an idea of what they're doing. And then they're going to look at the numbers too. They want to see, they're going to do a quick consistency check here. They want to ensure that the figures that were on your audit are tying back to the 990. And I'll note that they should, because often the 990 is prepared by your audit firm. It's very rare if, let's say, one firm is doing your 990 and a different firm is doing your audited financial statements. But regardless of whatever the case might be, you want to ensure that these numbers do tie. And this section here will set the tone for the rest of the Form 990. So clarity and consistency do really matter. Here on part 3, this is where funders will go to understand what you're actually doing and whether it's making a difference. This section is going to highlight your organization's major programs and their impact. Funders are looking for clear, plain language descriptions of your services and, whenever possible, measurable outcomes. Measurable doesn't have to mean complicated. It might mean the number of people served, or services delivered, or outcomes achieved during the year. So we showed that example of the mission statement, but here is a good example of what funders will see for like a program service accomplishment. Here it's clearly explaining what the program does. They provide job training, career coaching, and placement support for low-income young adults. How many people they served? It's saying that they served 325 participants. What outcomes were achieved? 2,400 hours of job readiness training and individual career coaching. It also further explains that 78 participants completed the program, while 65% secured employment or paid internships. So all in just a few sentences, it's briefly noting the program change, and that helps explain the year-over-year differences as well for funders. So at the last sentence here, it's saying that they expanded in this current year to include partnerships with 5 local employers. So quickly, it's telling a story about why last year might look different from this year. And because part 3 is public and frequently reviewed during the grant process, it's essentially a free place to have storytelling and a marketing opportunity for your organization. Keeping the narratives concise, clear, and focused on results can go a long way with funders. Now, part 6, this will focus on the governance policies. It's often ignored because it's that section where there's a lot of checkboxes here, but funders are reviewing this for some key indicators of strong oversight. While most of these policies are not required by the IRS, funders generally expect to see yes as a best practice signal. So for example, management and board should review these, or not for example, I'm sorry, but management and board should be reviewing these questions carefully to ensure that accuracy and demonstrate accountability. And having these policies in place signals strong governance and financial stewardship. So here in 11A, the question is asking whether the organization provided a complete copy of the Form 990 to all members of its governing body before filing. We recommend designating an individual or a committee member to conduct a detailed review. And then for example, it could be a treasurer or a finance committee or a board member that has relevant experience or expertise to serve as a detailed reviewer. The takeaway here is that funders don't just want policies on paper, they want evidence that the board is engaged and informed. Arrow. Now, on part 7, this will cover compensation for officers, directors, and key employees, an area of funders that they will review this closely. They'll look at the section to understand who's leading the organization and whether those individuals are paid or served as volunteers. Salaries and reported hours should be reasonable for your organization's size and reported on a calendar year basis so that they're tying to W-2s and the 1099s. This form does require actual numbers. Responses like varies or NA can raise questions. And because most board members are volunteers, reported hours should be realistic. So a board member here shouldn't say that they're volunteering 40 hours per week. Typically, I'm seeing anywhere between maybe 2 hours to 5 hours per week. That seems more reasonable from a board member perspective. And then on part 8 of the Form 990, this section is talking about breaking down the revenue. It's showing your revenue sources like contributions and grants, program service revenue, and other revenue such as investment income or fundraising events. Funders are looking at this section to assess whether revenue streams are diversified and relatively consistent over time. Be prepared to explain significant shifts year over year or unusual other revenue, such as, for example, unrelated business income. In short, funders are using this section to understand how stable and sustainable your funding model really is. Now, in part 9 of the Form 990, this is detailing the expenses by category, that program, management in general, and fundraising. This is very similar to that statement of functional expense we looked at from the audited financial statements. So both the audit and the Form 990 provide accurate reporting of the functional expenses. But the way it starts is through proper tracking in the accounting system. So for some QuickBooks users, if you're using QuickBooks, we often are doing this for our clients using the class feature. We do have a webinar we've done previously on our website about nonprofit financial reporting, building a simple system for complicated needs that discusses this in more detail if anybody's interested. And funders generally expect most resources to support program activities, often referred to as the program ratio. The ratio is important because it isn't only telling the full story, so you have to be ready to explain yours. For example, if it's a new organization, then you may have higher administrative costs early on. Let's say if you've done infrastructure investments such as technology or staff training, that could temporarily raise your support costs, but it's adding long-term value. And then for public charities, there's an expectation that you're soliciting donations, so there will be fundraising expenses. If, let's say, you are a public charity and there's missing or zero fundraising costs, that could raise red flags for funders. Again, funders are not looking for perfect. They're just looking for transparency and explanations that make sense. On the Schedule A of the Form 990, this is providing information about your public charity status and how your public support is calculated. Key examples of public support include direct donations, grants, membership fees, and gross receipts from volunteer-run fundraising activities. While Schedule A is best left to your tax accountant to prepare, management and board should monitor the compliance throughout the year to avoid any surprises. Paying attention to maybe large contributions from individuals and corporations, especially those that could exceed the 2% tipping threshold. And also watch for excessive support from disqualified persons, for example, board members, since those amounts are generally excluded from the public support numerator. And for 509A2 organizations, they're often having higher level of earned revenue. It's important to monitor the reliance on investment income and unrelated business income in this situation, because those generally should remain at or below 33.33%. This monitoring matters because failing the public support test for 2 consecutive years could result in the loss of your public charity status and automatically reclassify the organization as a private foundation. This is one where waiting until the year end could create problems that you're not able to easily fix. And I just wanted to provide a little bit of context here. We also often are explaining organizations as a 501c3. This is the general tax umbrella for organizations in general. Whether it's that federal tax exemption for charitable or educational, religious, scientific purposes, etc. 509A1, these are public charities that are primarily supported by donations and grants, while a 509A2 is a public charity that is supported by a mix of donations and mission-related earned revenue. So we have examples, entity examples of each here, but I just want to kind of provide that context there for everybody. Now in the Schedule O, so we keep talking about that transparency piece. This is where you can put that. This is where it'll help support the responses that you're entering elsewhere on the 990. If those yes or no answers, you can add some explanation to it in this section here. A very common example is explaining governance practices, such as how the board reviews the Form 990 before it's filed. So we gave an example earlier. If you're an organization where the treasurer or the finance committee member is conducting a detailed review and the full board is given the opportunity to review and ask questions prior to filing, you can explain that here. It's also allowing you to provide details about conflict of interest, whistleblower, and document retention policies. It'll help explain how officer and key compensation is determined. It can be a space to describe any significant changes in revenue or expenses. It's even a place to note unusual grants that are excluded from the public support calculations. Provide required lobbying or fundraising disclosures. Explain any differences between the audited financial statements and the Form 990. A tip, you want to always reference the specific part and line of the Form 990. So for example, here we're showing the example here relating to that question from the governance section. It was under Part 6, line 11A. Adding that little extra context just helps somebody to go flip back to what section you're referring to when you're adding some narrative here. So it's important to just help provide that context as well. But this is that part where you have the opportunity to proactively explain your story instead of letting the funders guess what's happening. So that brings us into our poll question. So, what is the primary purpose of Schedule O from a funder's perspective? Thank you, Elijah. Is it to provide the math calculations behind the numbers? Is it to repeat information already shown elsewhere? Is it to explain context behind numbers and yes or no answers? Or is it to disclose donor identities? As you're answering this, think about what funders need when something on the Form 990 is raising questions. And if we have majority, Elijah, could you close the poll? Thank you. Wow, awesome. Exactly. So Schedule O, 100%, is where organizations can proactively explain what funders might otherwise misinterpret, whether that's a policy response, a shift in funding, or a governance practice. Instead of letting the funders guess, this is your opportunity to tell the story behind the numbers. Now, one final but important thing to mention on the 990 is in Part 11. This is the reconciliation of net assets. It's reconciling the audited financial statements for your net assets to the Form 990. This section explains differences between tax reporting on the Form 990 and accounting requirements reflected in the audit. These differences can often occur because certain items are just treated differently for tax reporting than for financial reporting purposes. So throughout the year, it's important to monitor items that commonly will drive these differences. Something I'm often seeing is donated services. So if you're getting a donated service from an organization and you're valuing that on your form, on your audited financial statements, that number is not being included in the revenue calculation on your Form 990. Another example, if you have a facility, use of facilities, percent amount here, that can be listed on here. Investment gains or losses is invested on here, added on here. Another one that's not so common, but does happen occasionally, prior period adjustments, maybe through the audit, something appears that was done incorrectly, and there's a prior period adjustment, that would be listed here. Sometimes unusual grants. But ultimately, this reconciliation is explaining why your audited financial statements in the Form 990 may not match. And it's helping funders understand that those differences are expected when they're reviewing it. And then we want to end this section with just a quick reflection scenario. It's probably something funders are seeing all the time. So imagine that your nonprofit's latest financial reports are showing low unrestricted cash, a large balance of donor-restricted net assets, an operating deficit, and a relatively high percentage of fundraising expenses. So take a moment and think, what might explain these results? And how would you communicate them to funders in a way that's clear and not defensive? You're not trying to spin or justify anything. You're simply trying to provide context. So behind issues like these, there's often a very reasonable explanation. Something I'm thinking when I see these items, maybe there was a capital campaign in progress. Maybe there's timing delays in government funding. Or maybe a strategic investment that's raising costs in the short term, but supporting long-term sustainability. This is where tools like Schedule O narratives, audit footnotes, and management discussion become incredibly helpful. They let you explain what's going on instead of leaving funders to guess. So here are some examples that might explain how that could be framed. I wanted to like sort of address the one in scenario 2. So for example, it's funding delays. We incurred higher fundraising costs this year as we work to help diversify revenue following a federal funding delay. Those efforts have resulted in new grant commitments for the coming year. So that's a very reasonable explanation. All of these other ones, they're not defensive, they're just factual, forward-looking, and tied to strategy. Now, we've talked through the 990, we've talked through the audit, so let's get into some best practices for presenting this information in the audit and on the Form 990. Now, keep in mind that funders, again, are rarely expecting perfection. They just are looking for that clarity and context. So a helpful way to think about it is that funders tend to assess financial health in 4 buckets: liquidity, revenue diversity, expense trends, and operating results. If you can explain what's happening in each of those areas and tie your explanation back to your Form 990 narratives or maybe your audit footnotes, it'll help sound you're being prepared, transparent, and strategic. And to close, we want to quickly walk through each of these four areas, not in detail, but to highlight the kinds of questions funders are asking themselves when they're reviewing both documents. So for liquidity, this signals that an organization can meet its short-term obligations and keep day-to-day operations running. If cash gets tight, funders want to know that you've got a handle on it. So what they're really zeroing in on is cash and assets that can be quickly converted to cash and how those compare to short-term liabilities. That ratio of current assets to current liabilities tells the story pretty quickly. And when assessing liquidity, keep in mind that assets aren't available for general use should be excluded. So these are things like donor restricted funds. They should not be like, let's say if you have cash, restricted cash, that should not be included in this calculation for designated reserves or maybe a collateral balance. Those are on your statement of financial position, but they cannot be used to cover a general obligation. And then if a funder asks about expected surpluses or deficits and their effect on future operations and cash flow, being ready with a clear and honest answer goes a long way towards transparency. On revenue diversity, this matters because it demonstrates how stable and viable your funding model really is over the long term. If your revenue is spread across multiple sources, funders will feel that they'll feel a lot more confident about the resilience. So what are they looking for specifically? Multiple and varied revenue streams. Whether you're leaning maybe too heavily on a single donor or grant or funding source, that concentration is what raises eyebrows. Something worth flagging here, restricted revenue can make flexibility tighter than it looks, even when total revenue appears strong on paper. So being upfront about it through the Schedule O or the narrative or the audit disclosures, that shows you're understanding your own financial picture. And the questions funders are tending to ask here, is the organization overly dependent on one funding source? And how vulnerable is the revenue mix to disruption or non-renewal? If you can answer those confidently, you're in great shape. On the expense trends, these matter because they're revealing whether your spending patterns actually align with your strategy and long-term sustainability. Rising costs, as we're all experiencing, they're not automatically a concern. They do need to make sense. Funders are looking at trends in total expenses over time, especially whether expenses are growing faster than revenue. They also will pay close attention to that cost allocation methods. Are they reasonable? And are they being applied consistently? Now, there are cases where expenses spike for good reasons. One-time costs or maybe a strategic investment like technology upgrades or infrastructure, that rainy day thing that might happen. But anything can temporarily push a cost up. And that's fine as long as you can explain it. And on the allocation side, your methods should be documented and applied consistently year over year. And these questions you should be ready for are what's driving changes in expenses year over year? And are those increases intentional, temporary, or structural? And just being able to walk through that story clearly will give the funder confidence. Now, under operating results, these matter because they're indicating whether your current operations are financially sustainable. This is really the bottom line question for funders. They can tell the organization, can it sustain itself on what it's doing right now? They are looking at operating surpluses and deficits, but not just 1 year in isolation. Funders will want to see trends across multiple years to understand the bigger picture and whether the trajectory makes sense. A deficit doesn't automatically set off alarms. It may reflect timing issues, planned growth investments, or restricted funding dynamics. But you need to be able to explain it, and that context is what separates a red flag from a strategic decision. So some key questions here. Is any surplus or deficit expected and explainable? How does any surplus or deficit affect future operations and cash flow? Being able to answer those questions with clarity and confidence helps funders understand that you're leaving them with a gives funders a strong impression of your organization. And that brings us to our final poll question. So which of the following might prompt a funder to ask follow-up questions during their financial review of a nonprofit? And Elijah, if you can pull this poll up.
Nicole, we have a number of questions in the
Great.
chat. If people have to drop off and their question, because it's 5 to 10 and their questions aren't answered,
Yes,
we could follow up with them, correct?
definitely. And I can
Right.
even stay on extra too, so I'm happy to stay on if people are able to stay on. We can answer this one quickly. So B is the answer here. It's the percentage of program expenses compared to total expenses changed dramatically over the past 3 years. That'll raise a bigger question, and they'll immediately be like, well, what happens? And I'll just kind of glance over these next two slides here real quickly. But again, we've discussed how your audit and your Form 990 are giving that clear picture. So funders are using these reports to quickly assess whether the organization is stable, transparent, and well managed. And then we wanted to leave you with some common metrics that you can use. So these are some things that you can definitely go through at some point. Like it's just a takeaway for yourself. I will share the slides as well. So you can definitely look at this. And as I've mentioned, they're not looking for perfect. They're just looking for clear explanations that they can trust. And so that is my end. And I'll take questions here. So I'll end my slideshow so that I can answer questions for
That
everybody.
that was great. Thank you. I'm going to ask the ones that are in the chat.
Okay.
First one is program service accomplishments. Is there a best practice for which you choose to highlight? For example, based on program budget, size, or impact?
Great question. So yeah, you don't want to put on there every single program you are doing, but I think so I will have to say size will play a big factor because I mean, if you have a very large program and you don't have any explanation about it, that's going to raise something with funders, right? So I would say program size would be priority. But if let's say you have one that's a little bit smaller, but it is a huge impact, I would definitely highlight that as well. But I definitely think size would probably play a bigger factor there.
Okay. Our organization doesn't have a large budget. We have a financial review by an outside accounting firm rather than an audit. Is this a mistake?
No, it's not. So any organization, if your revenue is 999,000 or less in revenue, you are required to have a review. And a review is perfectly fine because funders do understand the threshold for New York State. If you are earning revenue 1 million or over, then you should be getting an audit, and that is something you can discuss with your CPA firm. It is not a mistake. A lot of the things that I discussed are going to be in your review. So you're still going to have a statement of financial position. You're still going to have a statement of activities. You're still going to have a statement of cash flows and functional expenses. And you'll still have, you may not have like as robust notes as an audit, but you will have something that can help explain some narratives. So no, it's definitely not a mistake. It's absolutely still perfectly fine.
Right. And I'm so glad, by the way, that you're focusing on the narrative because I think it's something that people really take for granted year after year, and the funders do look at, and it really is an
Yes.
opportunity to both market your organization, but to explain situations as well.
Abs Absolutely. And
Espe-
like I
And
said, like, oh, sorry, go ahead.
no, especially the slide you gave with the ratios, we're told to
Mhm.
act as businesses, and then if we have, too much in reserve, we're criticized. So to be able to say we have X amount in reserve because that is the responsible best practice, and to
Mhm.
explain, what's a restricted reserve, what isn't, that you're given a lot of space in your 990 to explain things, and we should use that and don't forget to change it every year, even if it's, that funders will see that you're not changing it. And you may have an explanation in one 990 that doesn't really make sense for the next year. So
Yeah.
yeah, I love it.
I like I have one client who would put numbers in the 990 and that was great. But I would very like pointedly be like, you need to review this every year. And I would go through it with them. I'm like, do these numbers make sense this year? They might have made sense last year, but they might be different this year. So you have to look through each of these places and don't just leave it to your grant reporting, right? To tell that narrative. These are easy places to put that narrative in and that explanation. So I couldn't agree more.
And I think you're still sharing your screen, but it's
Oh,
not.
am I? Oh, I'm sorry about that. Oh, you see my pretty
Yeah,
background.
it's
Okay, let me stop
beautiful.
sharing. Sorry
It
about that.
says, our organization undergoes an audit every year, but the audit doesn't start until the end of May when our audit firm has the allotted time.
Yep.
Is this a mistake? Seems quite late. Our organization should be ready within 60 days of end of year. We are a calendar year.
Yep.
Also, our organization has a healthy surplus. Is that looked at as negative, not spending enough?
So couple of thoughts there. One is auditors, right? Every audit firm does from January to May 15th is their busiest time. So there are times where they're not going to be able to get it all done. So I know I said the general rule is within 90 days. Obviously, there's not things you can control in that. And so again, if you maybe that's just a quick little sentence in your narrative of some sort of like, we're doing this because this is when we're fitting into our auditor schedule. Or maybe it's a discussion with your auditors. Is there anything we can do to get it done earlier? Possibly there might be something that they can move around in their schedule to get you up earlier. But it's not a mistake. I am seeing clients are extending their 990s because they're not usually having the audit done by May 15th so that they can get their 990 filed by then. The other piece of it is I want you to be mindful of what your grants that you have. Some of them are very specific about when you need to have the audited financial statements to them and the 990 to them. So you want to keep in mind any deadlines for them and then work backwards with your auditors to ensure that you're meeting those deadlines. And then what was the other? Did I hit all the points on that, Shan? I'm trying to remember. I feel like there was a third question
Yeah,
in there.
we did our organization has a healthy surplus. Is that
The
looked at as
surplus.
negative? And we discussed, health, yeah, healthy surplus could be a positive if explained and acting like a,
Absolutely.
yeah.
Absolutely. And I think too, it's like that's where if you do have restricted grants, are you spending enough towards those restricted grants? Because that might be something that a funder will look at. Okay, you have a healthy surplus, and that's fantastic. You can then maybe say, well, we have a healthy surplus, and our goal is to kind of put money aside because we're looking to purchase a building down the road or whatever your strategic goals are for the organization. But you can explain it. Absolutely.
Okay. And then the last thing I see here, David, are you still on?
Yep, I'm here. You want?
Okay. So I'll read the question.
Thanks.
You've stressed how important it is for our organizations to not have audit delays. So my question is related to timing of making these documents available. Besides organizations' own website, the main way funders get access to these documents are the IRS website and the New York State Charities Bureau website. In our experience, although the IRS posts filings promptly, the Charity Bureau has a 3 months, a many month, at least 3 months delay in posting their filings to their website. Are you aware of anyone raising with the Attorney General's Charities Bureaus the negative impact of nonprofits of these posting delays to see if they can work down their backlog?
It's a great question.
Yeah.
I don't have a specific answer on that, but what I will say is the funders are looking at the dates on those documents. So when you are submitting them with your grant reports, the audit is going to have on the audit opinion the date it was filed. So they'll see that it was filed timely. They'll look at on your Form 990 when it was signed and the date that it was signed. So those are two very physical dates that, regardless of when they're getting posted on the state website or the IRS website, it's not showing that you are delayed as an organization in getting these done timely.
Got it. So the point being, you're assuming that the funder requested these documents as part of the funding application, and it's not a situation where, for example, a foundation is solicited for funds, but outside of a formal application, and they're looking for these documents as
Right.
part of the
And like,
decision.
I think also the funders are understanding, right, that some of these things are not getting uploaded immediately, that there is delays. And so even if they're looking at one from 20, let's say now here we are in 26, you're looking at your audit from 24 and your 990 from 24 because you're 25, presumably you're not up there. They understand that piece of it. And if they want it, if they're very interested, they're going to ask you for it, right? They're going to ask you for something more current if, let's say, it's not available on a public website.
Thank you.
You're welcome.
Nicole, thank you so much to you and your part-time controller.
You're welcome.
This was great. Really appreciate it. And
You're
thank
very
you,
welcome.
everyone.
Thank
Thank
you,
you.
everybody. Have a great rest of your day.
You too.